Margaret worked at a bank for 31 years. She did everything right. She paid her taxes. She let her Social Security sit and grow. She counted on her monthly check like a second heartbeat. She watched the news. She voted. She trusted the system. Then she turned 64 last spring, and a man from the local Social Security office sat across from her desk and said three words she did not want to hear. He said, "You claimed early." Margaret had filed for her retirement check at 62 because her sister told her that was the smart move. Her sister was wrong. From that single decision alone, Margaret is now locked into a smaller check for life. Not for 1 year, not for a trial, for life. And the new 2026 rules just made that gap wider than she ever imagined. This came from a federal rule change that just kicked in, a quiet update the Social Security Administration, the IRS, and the Centers for Medicare and Medicaid Services all posted on their websites in the same few weeks. Nobody mailed her a pamphlet. Nobody called her on the phone. Margaret is the one paying for it now. Before we go any further, tap subscribe and hit the bell because the next 3 minutes could be the most important information you put on your side all month. This is not entertainment. This is preparation. This is the version of your future you need to see before January changes it. We are not asking you to like the video. We are asking you to put a working knowledge base in your pocket so the day you or your parents, your aunts, your uncles, your neighbors walk into a Social Security office, a Medicare meeting, or an IRS letter, you already know what to do. Let's talk about what just happened. The Social Security Administration, the IRS, and Medicare each released new rules that took effect in 2026. None of these are Supreme Court rulings. None of them came with sirens. They came with paperwork, dollar amounts, and effective dates. And if you were born in the 1950s, every single one of them can change how much money lands in your bank account, what age you can collect full benefits, what Medicare pulls out of your pocket each month, what the IRS demands from your retirement savings, and even how that money is delivered. This is the collision. On one side, you. Your decades of work, your savings, your plan to stop working and actually enjoy the time you earned. On the other side, three federal agencies adjusting the math, moving the goalposts, and trusting that you will not notice until it's too late. That is the fight, and the fight is happening right now. Here's the first rule change, and it is a big one. The full retirement age. That means the age at which you can collect your full Social Security retirement benefit with no reduction, no penalty, no clawback, has been climbing up a staircase for years. That staircase now hits 67. Starting in 2026, anyone born in 1960 or later has a full retirement age of 67. But here's the part most people miss. The people born in 1955, 1956, 1957, 1958, and 1959 are on the steps in between. If you were born in 1955, your full retirement age is 66 and 2 months. If you were born in 1956, it is 66 and 4 months. Born 1957, it's 66 and 6 months. Born 1958, it's 66 and 8 months. And if you were born in 1959, it's 66 and 10 months. The youngest boomers on that staircase, they are the ones who feel this rule move the most because the longer they wait, the closer they get to that 67 mark and the smaller the gap becomes between early retirement and full retirement. The Social Security Administration made this change decades ago in law. But 2026 is the year it lands on the last person walking up that staircase. If you thought you had until 66 forever, you do not. Your number moved. Now the second rule change. The cost of living adjustment, the COLA, is the annual raise Social Security gives your check so it can keep up with inflation. For 2026, the Social Security Administration announced a 2.8% increase. That sounds small. It is small, but it is real money. The average monthly benefit is going up roughly $56. So if you were collecting around $2,015 a month in 2025, you will see something close to $2,071 in 2026. That is $1,200 more over the year. $1,200. $1,200 you did not have last year. That matters. For a boomer living on a fixed income, paying rent, paying for groceries, paying for medicine, $1,200 is a car repair, a winter heating bill, a grandchild's school year. The COLA is not a gift. It is a federal rule that ties your check to inflation so you do not get bulldozed by prices. And the rule for 2026 is 2.8%. That is your raise. Take it, track it, make sure it shows up. But here is where the trapdoor opens. Here is where most people lose. Just because your Social Security check went up by 2.8% does not mean you get to keep all of it. Medicare Part B took a bigger bite out of your hand in 2026. The Centers for Medicare and Medicaid Services set the standard monthly Part B premium at $202.90. That is up from $185 in 2025. That is a jump of $17.90 a month. For most enrollees, this is the largest dollar increase to the Part B premium since 2022. And the Part B deductible also went up. So in plain English, and this is critical, your raise might arrive and your Medicare premium might eat most of it before you ever touch it. For the average boomer who was netting about $80 extra a month after the COLA, the higher Medicare premium swallows roughly 20% of that raise on its own. That is the trap door. That is where people lose. They hear raise and they celebrate. They do not hear premium. They do not hear deductible. They do not hear, hold on, let me see what the net is. That is the mistake. And that mistake belongs to the agency that did not tell you and the viewer who did not check. Now, the third rule change, and this one catches people who are still working. The Social Security earnings test. If you are under your full retirement age and you collect Social Security while you are still earning a paycheck, the government docks your benefits. They call it the retirement earnings test. For 2026, the limit is $24,480 a year. That is $2,040 a month. For every $2 you earn above that limit, the Social Security Administration withholds $1 from your benefits. That is half your income. Gone. The trapdoor here is real, and it has crushed good working Americans for decades. A school teacher who works summers, a contractor who takes odd jobs, a widow who keeps a part-time retail job to make ends meet, and finds her Social Security check cut in half because she earned too much. Do not say yes to extra hours without checking this number first. Do not sign a new contract without running the math first. That is where people lose. The rule is older than most of your children, but the limit moves every year. And the 2026 limit is $24,480. Now, the fourth rule change. The IRS required minimum distributions. That is the rule that says, you reached a certain age, the government wants its tax money now, you must pull money out of your tax-deferred retirement accounts every year, whether you want to or not. The age for that requirement is 73 for most people. If you were born in 1960 or later, the age moves up to 75. If you are a boomer reading this in 2026 and you have already turned 73, you are already inside that window. The IRS updates the life expectancy tables used to calculate how much you must withdraw each year. If you skip the withdrawal, if you forget it, if you do not know about it, the penalty used to be 50% of the amount you should have taken. Congress reduced that penalty under recent law to 25%, and in certain cases, 15%. But a penalty is still a penalty. A withdrawal you did not plan is still a tax bill. The IRS does not wait. The IRS does not mail you a courtesy notice that you will remember. The IRS sends a letter, the letter shows up, and the letter is not a warning, it is a bill. Now, the fifth rule change, and this one is the quiet one. Beginning on June 2nd, 2026, the Social Security Administration will fully transition to electronic payments. No more paper checks, no more going to the mailbox for your benefit, no more standing in line at a bank to cash it. If you are one of the boomer holdouts who still receives a paper Social Security check in the mail, you have until June 2nd, 2026 to switch to direct deposit. After that date, paper checks go away for federal benefits. That's the rule. That's the date. If you do not sign up for direct deposit, your money does not stop, but it changes form. You will be required to use a direct deposit account or a prepaid debit option called Direct Express. That is the federal government's choice, not yours. So if your parents, your neighbors, or your friends still get that paper check, this is the moment to walk them through setting up direct deposit before the deadline hits. Now let's talk about the trapdoor pivot, because the biggest risk in 2026 is not any of these rules on their own. The biggest risk is what people do after they hear about them badly. They panic. They call their Social Security office the day after they hear about the full retirement age change, and they file for benefits at 62 because they are scared. They accelerate the decision that costs them the most money for life. They sign up for Medicare without checking whether their doctor still takes assignment. They fail to update their direct deposit. They let the COLA come in without checking whether their Medicare premium automatically went up too. They hand their retirement accounts to a relative to watch, and then the IRS asks where the required minimum distribution went. That is the mistake. That is where people lose. Not because the rules changed, because they reacted to the rules changing without preparation. That is the trapdoor. And it is not on the government's website. It is in your behavior. That is why we built the survival protocol, not as a checklist, not as a numbered set, but as a simple real-world set of actions you can run starting this week. Read it once, then live it. Step 1, pull up your Social Security statement. Every working American has one. Go create an account at SSA.gov if you have not already. Look at your estimated benefit at age 62, at your full retirement age, and at age 70. Look at the actual dollar amounts side by side. Then make the decision with your eyes open, not because your sister told you to claim early. The difference between claiming at 62 and waiting until 67 is not small. For someone with average earnings, it can mean hundreds of dollars a month, thousands a year for the rest of your life. That is not a small decision. That is the decision. Step 2, check your Medicare premium and your plan. If you are on Medicare Part B, the standard premium for 2026 is $202.90. If your income is higher than the standard threshold, you may be paying more through an income-related monthly adjustment amount. That means your premium goes up because your income from 2 years ago was higher. If your income has dropped since then, because you retired, because you stopped working, because a spouse passed, you can appeal. You can request a reduction through a form called a life-changing event request. Do not let the premium quietly sit higher than it should be. Step 3, make sure your direct deposit is set up. If you or your parents still get a paper Social Security check, set up direct deposit before June 2026. It takes one form. It takes one bank account. It removes one of the most common points of failure for retirees: lost mail, stolen mail, mail that never arrives, mail that arrives too late. The government is moving to electronic payments whether you are ready or not. Be ready first. Step 4, if you have retirement accounts, a traditional IRA, a 401k, a 403b, a SEP-IRA, make sure you know your required minimum distribution age. For most boomers, that is 73. Mark the calendar. Talk to your tax preparer. Take the withdrawal on time. Miss it once and the IRS will hit you with a penalty that was 50%, now reduced but still real. 25% of what you should have taken. 15% in some cases, still money you do not want to lose. Step 5, do not let anyone rush you. Not a phone call, not an email, not a limited time offer from someone claiming to be from Social Security. The Social Security Administration will never call you demanding your bank information. The IRS will never email you a link. Medicare will never send an agent to your door to collect your premium in cash. If you receive a phone call that pressures you to claim now, verify now, or send money now, hang up. If you receive an email that threatens you with arrest or benefit loss, delete it. If someone shows up at your home claiming to be a federal agent and asking for your personal information, do not hand it over. Call the agency yourself. Use the number on the official website. Confirm. Then act. Step 6, tell someone. Tell your spouse. Tell your kids. Tell your brother who never watches the news. Tell the elderly neighbor who lives alone. The reason these rules hurt people is that they hit them alone in silence after years of trusting that the system would protect them. The new way is the prepared way. The new way is the family way. Talk about this at the kitchen table. Let me say this clearly so it lands. The 2026 rules are not a conspiracy. They are not a punishment. They are an adjustment to a system that is older than most of the people watching this video. The system is large, it is slow, it is run by humans who make adjustments on a schedule, and you do not have to be one of the people who finds out about these adjustments through a letter that arrives too late. You can be the person who sees them early, plans around them, and walks into the system with both eyes open. The full retirement age climbs to 67. The COLA is 2.8%. The Medicare Part B premium is $202.90 a month. The earnings test limit is $24,480 a year. The RMD age is 73 for most boomers. Direct deposit becomes mandatory after June 2nd, 2026. None of these are guesses. None of these are rumors. They are posted. They are public. They are the law of where you are right now, and they will change how much money you keep, how much money you lose, and how much money stays in your hands. Do not say yes to anything that does not match these numbers. Do not let anyone pressure you into a quick decision about your benefits. Do not trust the first letter. Do not trust the first phone call. Trust the source. Trust the official agency. Trust the number you can verify on the official website yourself. This is not the year to be polite, obedient, and quiet while the rules change around you. This is the year to be the person in the family who says, hold on, let me check that. Let me verify the date. Let me read the form. That is where people win, not because they are smarter than the system, because they wait one more day, ask one more question, and verify one more number before they sign. You were born in the 1950s, you built the country, you carried the country, now the country is changing its paperwork. So carry the paperwork back, read it, question it, plan around it, and do not let anyone, not the agency, not the agent, not the well-meaning relative, not the salesperson, make a decision about your retirement money on your behalf without your eyes wide open. This is the year you stop being surprised. This is the year you start being prepared. The rules just changed. You now know what they are, use them, live by them, and do not hand your future to anyone who has not earned it.